Hi all, it's me Hari this side. So today we have Ayush with us. So Ayush trades
Hey
in
guys.
crypto and he's also a part of our community. So I just thought about breaking down the trade, the double top trade that he has actually taken recently in cryptocurrency. So first let's understand what double top pattern is. So let's quickly understand what a double top pattern is. So let's assume that the price was initially 95 and then the price actually manages to reach 100. From there it faces some sort of a rejection. Again from here, again it is like picking up to the 100 levels. Okay. So now what happens is at any point in time, this level is actually again showing some sort of a good rejection. And this particular low point, which we refer to as a neckline, is getting broken. We anticipate a fall towards the all support levels. That is, if initially 95 was a support, then from there the price picks up to 100, faces rejection, falls down. Again from the exact same point 100, again it is facing rejection. And this neckline is actually getting broken. We expect the price to fall back to the 95 levels once again. So this is what we refer to as a double top formation. And these are actually good shorting opportunities if you're getting a risk reward ratio of 1:2. So risk reward ratio means how much risk you are taking. So if you're going for a short over here, most probably your stop loss is going to be kept above the high. The target that you can look out for would be the support levels over here. So now I'll pass it on to Ayush to break down the trade that he took and how he managed the risk, reward, everything in that particular short position in AVAX.
Now that we've seen how an M top breakout or a double top breakout happens at the neckline over here at 27, this is the AVAX tether chart, and the exact same situation happened over here as well. It broke down and came down to 23. So let's see what a bear call spread is and how the strategy actually works out. What a bear call spread is essentially taking a net credit. So you're selling two, like you're essentially making two legs of options. The first leg is buying an option, and the second leg is selling an option. These can be done in various ratios and also different types of strikes according to how you want to manage your risk and how you want to do your spread. The wider the spread or the more the difference is between the premiums, the higher your profitability, but also the risk is much higher as well. What I did with my trade now, so we can see that it took support at the level over here, and then it went up to the level of 28. Then we can see that over here we could see an M top formation and it was about to break out. So this is the breakdown that I was waiting for. Once it broke down, it came up to here and consolidated here. Now none of us could have predicted what happened over here. So why essentially do we do a spread? A spread actually helps you keep your position hedged from both the sides. Now the idea of doing a bear call spread. In a bear call spread, you wait for a sudden move or spike in premium. So a spike in premium is like a built up in premium. So at the point where the AVAX USDT pair was at 28, premiums must have heavily piled up. And at this time, what you can do is sell a call and also buy a call. This gives you a spread, like a net credit. So how exactly did I do it? What I did was I bought 50 quantity of AVAX of 7 June expiry, and I sold 150 AVAX for 11th of June. So how exactly does my risk to reward and my ratio of spread work out? So if you see over here, the ratio of my spread as well is 1:3, that I bought in the ratio of 1 and sold in the ratio of 3. My risk to reward as well was same over here. This was my risk and this was my reward. Alright guys, so I'm going to discuss more about what my strategy was behind taking the spread yesterday on AVAX. So primarily I look at Bitcoin and Bitcoin's levels. So I saw yesterday that Bitcoin was rallying towards the 32,000 resistance. It's a very strong resistance still, and Bitcoin hasn't been able to break through that for a while now. and I am pretty sure that the market's gonna rally around or move around this part for a while now. So around the time when I was taking this trade, let's look at it in a smaller time frame. So I was looking at the charts. I was up in the morning, and around afternoon 1:15 time, I was seeing that Bitcoin had rallied up 5.35%. I had already missed the long opportunity, but I knew that it would probably retrace back to either 30,700 levels or even move down to the 29,400 levels. So what I decided to do was instead of taking a trade in Bitcoin, I saw how other coins like other layer 1 coins such as Solana and Avalanche moved. Because what generally happens is due to Solana and Avalanche being smaller tokens, they move in a higher proportion than Bitcoin does. So I saw that around 115, 130, Avalanche had rallied up almost 14.58%. So I decided to go with a bearish spread. So I'll be discussing more about how I went on to do that on Delta. Delta is actually a very good platform for people who are already well versed with options world. For anyone interested in the options world in the crypto market, the go-to platform should be Delta. So let's look at how I went about to create my spread. So on the day I saw the levels and I saw that 30 was a good resistance level for Avalanche or AVAX. So I split my orders in two different ways. So the first order was for 91 at around 1.5, and the second order was for 61 at around 1.48. Obviously, the order with the lower premium also had lower quantity. So let's say only one of them got filled out, they'd be proportional. And so earlier I did not actually have a hedge place, and I thought about this later. So because if I had taken the hedge for the same day expiry, let's say I shorted the 30 AVAX call for 17th of June, and I decided to go with an OTM hedge. Even though the premiums were lower, they were not as low as not as low as something that I would get for daily expiry. So what I did was I could just directly, let's say, take daily hedges if I wanted to hold on to my position till the end of expiry. So that's what I did. I took the 6 June 30 AVAX call. I bought it for the premium of around 0.1390, obviously very low premium, but I used higher leverage on this. But my net PNL, even if it went down, would only be 6.67 USDT. So on the day that I taken the trade, this is how my trade was running. So after I had taken my position and also the hedge, uh, I was in net $4 profit. The total premium that I could collect on the day of expiry, if the trade did become successful, was 220. Almost 11 to 12 hours into the trade, in the morning at around 9:15 to 9:30, I decided to close almost 75% of my trade. Closed down 75% of my trade, and almost in an hour or so I closed down the rest of my position as well. So the net profit that I got out of the whole trade was almost $115.